All right, hi everybody. I am Cal Ewing, and I am here with Chris Burylo of Pinnacle Accounting in Calgary, Alberta, Canada.
Hello.
And Chris is my go-to guy when it comes to anything cross-border taxation for my real estate investing company. I basically do what he tells me to do. He's very knowledgeable when it comes to taxation on both the Canada and US side and how they apply together. And so, Chris, I just wanted to have you come in and answer some of the most common questions that other people ask me all the time about investing in the States as a Canadian.
Yeah, and it's great, Cal. I know when I first started working in taxation back in 2005, I was originally working in international tax.
Oh, wow.
Yeah, and then in 2009, I really started carving out this specialty in real estate tax. And so, like today, dealing with cross-border real estate is something I'm super passionate about, and something we really excel with.
Yeah, well, let's just start from the beginning a little bit. Tell us a little bit more about your background and also the fact that you're a real estate investor yourself.
That's right. Yeah. So, like I said, I initially started working in international tax before I went on to start and manage our own accounting firm. So I'm here today with Pinnacle Accounting and Finance. I'm the managing partner here, and we have an amazing team of 16 staff here in our office in Calgary. I went on to do a bunch of continuing education. I finished the Certified Financial Planner in 2009. I did the Certified Management Accountant in 2013. And then when the accounting designations merged, I initially became a CPA in 2015. And very exciting, actually, 2019 became a public business accountant as well. So I got through another designation check mark on there. So, by most standards, I think quite well educated and a lot of experience specifically in real estate and cross-border tax. My partner and I, since we're so passionate about real estate, we were seeing what some of our clients were doing, and we were helping out some pretty large accounts making acquisitions across the border. And we decided it was something we wanted to do ourselves. And so we set up a cross-border structure similar to some stuff I might talk about today with you, Cal. And we've been buying houses down in Texas for a number of years now. So we have a portfolio of houses in Dallas specifically. And so we're really excited about that. And it's really fun. And now that all the hard work's done, actually surprisingly easy to manage from a distance. So that's great.
Yeah. Well, and I think that's the myth is getting started, there's a big hurdle. There's a lot of unknowns, but if you've got the right information and people around you, it's really not that much different than buying here in Canada, really, right?
Yeah.
It's more about solving these problems and questions that you're going to help us with, I think, is the biggest challenge for most Canadians. Mm-hmm. And guys, I wanted to just say, when I build my own team, I'm always looking for people that understand my business. So when I met Chris and found out that he was a real estate investor buying houses in the States, it's one thing to just be a cross-border accountant, but the fact that you understand, our day-to-day challenges and my business, it was a real definite fit for me. So
amazing.
I think it's important. Yeah. Okay, Chris. Well, I think let's just talk about the big elephant in the room that most people ask, and that is, how the heck do I set up my business so that I can buy houses in the States as a Canadian?
Sure.
What entities?
Yeah. And you're right. That's such a great question. And the answer isn't always the same for everyone.
Right.
But I think that there are, maybe two or three go-to options, or, one option that we use a lot, but maybe two or three options available to most investors. And I like to tell people, we have lots of clients that, get involved in some one-off tax deeds down in the United States, or they might have, call it one rental property, and they're not looking to grow too much outside of that.
Yeah. And,
when people are looking to keep things simple and not build out a big elaborate portfolio, it can be really simple to just do everything in your personal name. And you lose liability protection when you do that, right? When you throw an entity in between you and your assets and your business operation, there's a nice liability protection there if something goes sideways. But if we're not dealing with a growing portfolio, sometimes the objective is hey, let's just keep our costs down and keep things simple so that we can do what we got to do without, accounting or legal fees and administration, putting too much of a burden on us.
Yeah. Well, it's costly. And I made that mistake starting out too, is I think a lot of people come in thinking they have to have this huge elaborate structure before they get started with all these levels of security, and they spend all this money and then they don't even get a property.
Right.
And I don't think that's what you're saying is the best way to go, right?
Right, yeah. Sometimes it's nice to take things slow and simple and make them more complicated later.
Yeah.
For me, when I knew that I wanted to start investing in the United States and in Texas is where we wound up, I knew that it was a long-term plan for me, that I wanted to build a portfolio over my lifetime, and that might become part of my own retirement plan. Yeah. And so for me, I knew that I wanted to take the time and the money to set things up right from the beginning. And in my case, I went to my business partner and my dad, a couple close friends, and a whole bunch of us pooled a bunch of money together. And then I did that because I wanted the economies of scale. I wanted to know that we can go down there and buy, in our case, 5 or 10 properties, cash, and, have a big enough portfolio that a more robust structure, the economies of scale, it'll take care of itself. Yeah. And so, so we went and we set up a structure, and I'll show you and then tell you a little bit about what we did and what we do with a lot of our clients. So we took a little bit of extra effort to set up a more robust structure for a long-term plan, better asset protection, and something that would be a better tax strategy, most importantly, some big on saving taxes. Yeah. Yeah.
Well, let me just ask first, why did you choose the U.S. over buying property here in Canada?
Oh, yeah. We're in Calgary, and anybody who knows the Calgary markets, cap rates on rental properties, we think, are they 3 or 4% or something right now?
Yeah, that's pretty darn low.
Yeah,
and then you got to put a basement suite in anyways.
Sure.
Yeah.
Interest rates on mortgages are 3 or 4%, so, what are we, so the numbers just aren't strong enough for me. Yeah. Some of the people that I see who are really successful in real estate, they don't do the status quo. They don't go on, MLS or realtor.ca, realtor.com. They don't go in their local market and just buy a property, that's listed. They do things a little bit differently. And, for some people, like you said, that means suiting out a property. For some people, if they're, handy and they can do fixer uppers or what have you. And for me, it meant, let's navigate, some of the, complexities of investing, in this case, outside of our country. And, you start looking at different markets. And it could be a simple, you could look at the East Coast of Canada or something like that, or Winnipeg has some pretty attractive markets. But, for me, I really like the idea of looking to the United States, and particularly some of the southern states, I think, have excellent rates of return on their properties. And, there's so much. It's easy to, read about all this literature that's written. I feel like some of the top real estate investors out there are all coming out of the United States, right? They pump out all this content, and, you hear stories about, Kiyosaki buying one property a year, and you can't duplicate that here in Calgary. Or else you'd be spending 2, 3, 4, 500,000 on these houses, and you go across the board to the United States, and you can buy a property for 100, 200,000 and generate some pretty good returns on it.
Or less.
And that that sounds so attractive to me.
Yeah. Right. And you've got the knowledge on how to set it up the right way, and so you went for it. Yeah.
So as an investor, I think if you can just do that little bit, that's a little bit different, and you put in that little bit of extra effort, and you can generate some much better returns.
Absolutely. Okay, well, let's get into it. What structure do you recommend? I know you said there's a couple options and everyone's different, but what's the basic thing you recommend people do?
Go-to structure. Yeah. Actually, I just want to address one common mistake that I see investors make. And this comes back to a lot of the literature that I think is out there. You go on Bigger Pockets, or, you read some articles or some videos about what Americans are doing. And a lot of people talk about, hey, let's put our money in an LLC in the United States and use it to buy a piece of real estate. That's what's in all the American literature. But the problem is that American literature was written for Americans investing in America. And of course, we're Canadians investing in America, and we speak with a slightly different accent. So we we got to do things a little bit different. And what I mean by this is, as a Canadian investing in the United States in an entity, we have to follow IRS, the US tax laws, as well as the Canadian tax laws. And those tax laws aren't always the same. So, for example, when an American puts their money in an LLC and invests in property down there, what they do is, in the United States, if you have an individual or a company, if you have just one shareholder of an LLC, that LLC can be called a disregarded entity. And what that means is any profits in the LLC don't have to be accounted for in the LLC. They can flow through to the shareholder, and that entity doesn't even actually have to file a tax return. So what people do is in the United States, they'll set up an LLC for every property they own because
they don't have to file.
Right, they don't have to file. They pay whatever, $100 or $200 a year to keep the LLC active. So the administration is super low, the cost is super low, and it gives them that peace of mind that, hey, if something goes wrong, this LLC is going to get sued. And the only thing it owns is one property, not my whole portfolio.
Right.
Okay. In Canada, when the CRA looks at that same LLC as a Canadian investor investing across the border, they do not treat the LLC the same way that the IRS would. They do not give an LLC the disregarded entity status, which means that LLC has to file a tax return here in Canada, and it actually has to pay taxes at a higher rate than a Canadian company. And so now you have this situation where, because I'm a Canadian investing in an LLC as opposed to an American, now I have to file tax returns for that LLC, and I have to pay taxes at higher rates. And so it's a common pitfall that we see where Canadians will think that's the right approach because that's what they've been taught.
Yeah.
And so there's a better structure.
So any of you guys that have heard to set up multiple LLCs for all your properties, do not do this.
Do not do that.
Pay more than you really should.
Mm-hmm.
Yeah. Okay. So all those benefits are not recognized by Canada.
That's
by
right.
The CRA.
By the CRA.
Okay.
Yeah. And
so what
Canada,
do we do?
What we do is So I like to set up a structure where instead of using an LLC in the United States, we set up a limited partnership. And a limited partnership in the United States will still allow profits to flow through just like a disregarded entity LLC. Okay, so it gets the same tax treatment.
Yeah.
But what's nice about the limited partnership is the CRA, the Canadian government, will treat it the exact same way. They'll treat it as a flow through. Well, profits will flow up to whoever the shareholders are. And it doesn't have to be just one shareholder, like an LLC. It could be a whole bunch of people. Okay. And a limited partnership, for those who don't know, is a type of partnership. But there are two different types of partners in a limited partnership. Okay, you have what are called the limited partners, and you have the general partner or partners. And a limited partner would be somebody who's putting in money or real estate, like assets, into the partnership, and they are limited to liability to only what they contribute to the partnership. Okay, so if you put in $100,000 in a limited partnership, if the partnership goes bankrupt and it has a bunch of debts because it gets sued and there's a bank foreclosure or whatever, something goes terribly wrong, hopefully it doesn't, the partners, the limited partners, are only responsible for what they contribute to the limited partnership. Okay, the general partner is the person or entity that takes liability for any shortfalls, any financial shortfalls that the limited partnership might have. So when we set up these structures, we typically set up a U.S. limited partnership where the limited partners could be you and your friends. It could be a Canadian limited partnership or your Canadian holding company, and there's lots of different ways you can incorporate that. And then you set up the general partner to be an LLC in the United States. And
so it's kind of your front line of defense from getting sued or something like that.
Yeah.
Okay.
And you set up this LLC so that it doesn't receive income. Okay. So it still doesn't have to file, right? If there's no income, it doesn't have to file the tax return down there. But if something goes terribly wrong, the LLC is your fall guy.
It's an empty empty shell in a sense, is it?
Yeah. I mean, our LLC in Texas, I mean, it doesn't even have a bank account.
Yeah.
Like literally, it has literally nothing. And so you get, really strong peace of mind setting it up that way.
Okay. So the limited partnership is the closest thing on the Canadian side that the CRA recognizes like an LLC. It's the closest equivalent, I guess, is what you're saying.
Yeah, you could say that because it treats the flow through of the income. Yeah, that's right.
Okay.
Yeah.
Now, why not just set up like a C Corp or an S Corp instead? Because I've heard of some people doing that as Canadians.
Yeah, I mean, it creates the same issue. One of the challenges that we run into with these corporations in the United States. Let me give you an example. If you have a Canadian company, okay, that Canadian company maybe has profits. Here in Alberta, active business income in a corporation only pays taxes at a rate of 12%. Okay, so some people find that pretty attractive. If you take a dividend from that company, the taxes on your dividend here in Canada are going to be much lower than your standard personal marginal tax rate.
Right.
And the reason for that is because the government considers that that company has already paid 12% tax to Canada, and in our case, the province of Alberta. And so you get a break on your personal taxes. It's something called the dividend tax credit, and it helps lower your personal taxes on that revenue. Okay. Yeah. Let's flip the equation. Let's say we have a C Corp or an S Corp or an LLC in the United States that's not a flow through. That entity will pay taxes on its profits in the United States. It'll pay taxes to whatever state it's doing business with, if that state has state tax. Some of them don't. Yeah. And let's say that company is going to issue a dividend home to you in Canada. Well, the Canadian government doesn't recognize that you've already paid taxes to the United States in that company. And so when you receive a dividend to Canada, they don't give you that dividend tax credit like they would a dividend coming out of Canada. And so your tax rate on that is your top marginal tax rate. It's the same as like getting interest income. So your tax rate on that goes up significantly. Canada and the United States have this fancy agreement. Canada has this agreement with most countries in the world, and it's in this case it's called the Canada-U.S. Tax Treaty. Okay, so Canada has tax treaties with a whole bunch of different countries, and I think one of the big purposes of the tax treaty is to try to eliminate double taxation. Okay, and the idea is if you're paying taxes to the United States, you shouldn't be paying full taxes again to Canada, because that would just suck, right? If you made $100, you gave $30 of it to the U.S. government, so you have 70 left, and then you give 30% of that to the Canadian government. You're paying like 50% tax. It's crazy. And so, what we want to do is we want to make sure that whatever structure we set up takes advantage of that tax treaty and eliminates double taxation.
Okay.
And so a limited partnership is one way that we can do that.
So that's the one way. Okay.
Yeah.
So you explained what a Canadian company, what you're paying if you had a Canadian company. How is it, what's the tax rate if I have a limited partnership? I'm paying my personal rate, or what's the rate that I'm paying as a Canadian?
So after all the administration kind of washes out, because the filing process is a little bit more complicated than you might be used to. But after that all kind of washes out, the best way to think about it is that your tax rate will be the higher of your Canadian tax rate or your U.S. tax rate, federal and state. And I mean, in most cases, Canadian taxes are a little bit higher than United States taxes. Yeah. So the best way to think about it is your overall tax rate should be the same as your Canadian tax rate. Okay, it should be the exact same. But in practice, some of that will go to the United States and some of that will go to Canada.
Right.
Yeah.
Yeah, but the total amount never exceeds the Canadian tax rate.
That's right.
So you're not actually getting double taxed if you have the right structure.
Right.
Yeah.
That's right.
Okay.
Yeah.
Okay. Because I get that a lot. People are like, well, I don't want to invest in the States because double taxation. Right? It's really not. It's pretty easy to avoid.
And there's something that comes up quite a bit, with in this case, the limited partnership structure. And you would encounter this same sort of thing if you were just investing personally. And it's this idea where the United States knows that the owner is a non-resident. And when money goes to them, they want to make sure they're getting paid their fair share of taxes. And so the government down there does this thing where if you're profitable in the United States, whether you bring the money home or not, you have to file these special reports sort of once a quarter. It's not exactly once a quarter. The schedule is a little funny, but it's sort of once a quarter. You have to file these reports, and you have to pay like a withholding tax to the U.S. government. So you kind of put money up in advance over the course of the year, and then at year-end time, you go and you file in the United States. And if you've you've probably over-contributed. That money gets refunded back to you.
Right. So, and that's one thing that I do is I have my bookkeeper work with my accountant, with Chris's team. And so every quarter, give or take, we're going to have to, if you've made profit, you got to pay withholdings tax. And it can slow you down a little bit, right? Because you may be paying more tax that you could be, putting into another deal, but it's just kind of part of doing business as a Canadian, right? And
it is. I think for some people, it gives them peace of mind too, though.
True.
I'm making money. Yeah, give to the IRS, and it sucks for your cash flow because you're dishing out money, but you know that you're on top of your tax obligations. So
you're not going to come short.
Yeah.
Okay. So that's definitely something to ask about is the withholding tax and how that applies. Now, what if you have a Canadian company? Do you advise people to have a company on the Canadian side that is like a partner to the American side, or what do you suggest there, Chris?
That kind of planning, that's really investor specific.
Okay.
And I think a good rule of thumb, and you can't apply this blanket to everyone. Everybody's scenario is a little bit different. And if it was my client and this question came up, I would probably say to them, look, come on in here. Let's get on the fancy blackboard and let's start making some pictures and figure out what makes the most sense for you. But a good general rule of thumb is if the money is already in your hands personally, it's good to kind of keep it there. Okay. And if the money is already in a corporation, it might be good to use that, because if you have profits in a company, if you have retained earnings already in like maybe your small business, it doesn't make sense to take the money. If you take the money out of your company, you're going to be paying, or you might be paying personal taxes on that withdrawal.
Right.
And so, if the money's in the corporation, you can defer that extra personal tax. Absolutely, we should. We see lots of clients who, have successful day jobs, whatever they're doctors or they're landscapers, or not even necessarily like super successful. They're just, average. They're just working people who happen to get paid to a corporation and happen to be doing a good job kind of saving some of that money. It makes a lot of sense to, keep that money in your corporation or your corporate structure. Some of these guys have multiple companies, and using that to deploy into the United States. I treat our corporations, like personally, my corporations and our corporate structure, I treat it as a replacement to an RSP, because if I take the money out of the company and contribute it to the RSP, I'm in the exact same boat as if I had just left the money in the company. And so, I just treat our corporate entities as my retirement plan.
That makes sense.
Yeah.
But you don't recommend, if I'm just a person, setting up a Canadian entity first. It's just a waste of money, right?
I think so.
Yeah. But if you have a business already, okay.
Yeah.
Okay.
Yeah.
All right, Chris, another question I've heard a little bit about is people lending themselves money to their USLP.
Oh, yeah.
Is that a real thing, or can you do that, or how's that work?
That's such a great question, Cal. Thank you for thinking of that. It's a great question because just over a year ago, the U.S. actually introduced some legislation to try to eliminate a very important tax strategy that we see with Canadians investing across the border. And we were kind of nervous that they were going to kind of quash this strategy. I'll tell you the strategy in a second. But about 3 or 4 months after they introduced the idea, they ended up canceling it. So we got kind of lucky. Yeah, Canadians investing across the border, we probably unknowingly dodged a bit of a bullet last year. And what had happened was historically, and we have a lot of clients that we do this with, where their U.S. limited partnership, instead of them owning it personally or through their corporate entity or whatever, they have it owned by a Canadian limited partnership. Okay, and then they actually, I have a slide here. I'll put up.
Sure.
They instead of putting their money directly into the U.S. limited partnership, they put their money into a Canadian limited partnership and have that Canadian limited partnership invest in the U.S. limited partnership. Okay.
Yeah.
And similar to the U.S. structure, the Canadian limited partnership would have limited partner investors that are you, your dad, whatever, your friends, your company, and it would have a general partner, which would be a Canadian company. And again, that's just your fall guy if something goes wrong.
Yeah.
But one of the neat things that we can do with this structure is, instead of having the Canadian limited partnership invest directly into, we call them units, like shares in the U.S. limited partnership, instead of them investing and buying that equity piece, we have the Canadian limited partnership issue a loan to the U.S. limited partnership. Okay.
Okay.
And one of the benefits for that is the U.S. limited partnership is now paying interest on that loan to the Canadian limited partnership.
Yeah.
And the reason you want to do that is because it drives down your taxable income on your U.S. limited partnership.
Okay.
And that means you submit less withholding taxes every quarter. That's the big benefit. That's why you do it.
So you're keeping your money moving more throughout the year.
Yeah.
Oh, wow.
So if you're like Cal and you're going like, man, I hate these quarterly filings and I hate writing this check to the IRS every quarter, one solution is, you set up that Canadian limited partnership and it issues a loan to the United States. And now the USLP has to pay interest on that loan. And
right.
I mean, it's just a wash. You're paying yourself interest.
Yeah.
So you're not actually paying interest, but
right.
you're taking that deduction on the US side.
Okay. So the Canadian LP is it's also a partner. It's a limited partner of your US LP?
Yes.
Okay.
Yeah.
Oh man, I might have to get that going here at some point.
Yeah.
Yeah.
Yeah. So
okay.
That's why we talk about
that clarifies quite a bit.
Different structures for different people. And, when you look at, I have some clients that are like big investors, like Canadian mutual fund trusts, or like something where you'll have like hundreds of people getting together and pooling capital together in one entity. And that's the type of structure that we use with them.
I bet.
Yeah. Because, you set up something a little bit more robust, you keep a little bit more cash flow, and, it just makes more sense. And, a bigger entity, a bigger pool of capital can afford and warrant a more complex structure, right? The nominal extra cost for, that many people just makes sense.
Yeah. And I want to reiterate again, because just based on my own personal experience, like, you don't need to have all of this set up at once. Like, get yourself to a certain point where you've got a big enough portfolio or a big enough business. Yeah. Because you can always do some of this stuff later on too, right? Like,
that's right.
It doesn't have to be, because you could just waste all your money and then have no money to use and buy houses. So.
Yeah, you're much better off just putting money into another house.
Yeah, so I recommend talk to someone like Chris first before you even get started, just so you can have a plan going forward, for sure.
Yeah, baby steps.
Yeah, absolutely. Okay, so say I'm borrowing money from that guy right out there.
Yeah.
And he's lending me $50,000 and I use that to buy a house.
In the United States.
In the US.
Yeah.
Okay, so they're my lender on title.
Right.
They're the lender on that property, and I'm paying them interest every month.
Oh, I see, yeah.
So they're earning interest in the US.
Right.
How do they report that?
How do they report as the lender?
Yeah. Do they have to file a U.S. return? Is it just on the Canadian side?
Yeah.
That's
so, the rule in the United States is if you have U.S. source income, it has to go on a U.S. tax return.
Okay.
And that could be you lending money to a borrower in the United States. It could be you buying property in the United States. It could be as simple as you buying stock on the New York Stock Exchange. Okay. And a lot of people don't even know that, but if you have a stock portfolio based on a U.S. exchange, you're technically supposed to file a U.S. tax return.
Okay.
Yeah. Not everybody does.
Yeah. Okay. So you're filing a U.S. tax return, and then you're also having to file on the Canadian side, but it would be the same as we were discussing, where you're just paying the Canadian rate.
Right. Yeah. It's the same. You're basically just paying the Canadian rate. So if you were like an individual, right, without a corporate structure and you were just lending money to a project down there, what would happen is you would file a U.S. tax return. Okay, you would pay the U.S. government any taxes that you have to. Okay, depending on how much money it is, you might not have a tax bill at all, but say you have a tax bill. And then you would file your Canadian return. You would declare the same income on the return. And because of that Canada-U.S. tax treaty, you get something fancy here in Canada called a foreign tax credit. So Canada basically says, hey, this is your interest income. This is the amount of tax you're supposed to pay on that income. But that amount of tax gets reduced by the amount of tax that you've already paid for the United States. So that's where that Canada-U.S. tax treaty comes in. And its purpose is to just make sure you don't pay double tax on the same income.
Okay. And so if you're just earning interest, what rate is that in Canada? How's that taxed?
Yeah, I mean, interest, it's taxed the same as interest income. It's at your marginal tax rate. So, that could be nothing.
Right. It depends on where you're
32%. It could be higher than that. It could be it could be anything.
Gotcha.
Yeah, depending on how much you earn.
Sure.
Yeah.
Okay. So let's talk about filing the returns and that process, and what are the costs if I'm having to file a return for this entity, like the limited partnership structure that you just talked about with the general partner and a limited partner in the U.S.
Right. Yeah. So filing with a firm like ours, like a U.S. limited partnership, assuming all the bookkeeping is done and the books and reports look good. Filing the U.S. tax return can range from probably about $600 to as high as $1,950 Canadian. Okay? And that cost in there will really vary depending on the size and complexity of a company. Okay?
Sure.
So, if you're thinking like, you have something established down there, you're making, call it minimum 30, 40, 50,000 up to $1 million, you would probably expect to be paying between $950 to $1,950 or so. And then if you're an entity that's, just, not quite there yet, you're kind of, trying to get things up and running, you're probably looking at more of a, call it $600 to $950 range or so Canadian dollars.
Okay. Yeah. And is that for both, like each entity separately or both entities together?
Yeah. So the LLC,
which is the general partner.
Which is the general partner, right? Okay. If it is set up properly, it probably doesn't have to file a U.S. or a Canadian tax return. And I mean, we see some situations where people use that LLC in different ways. And in those cases, it does actually have to file a tax return. Yeah. But if you set things up, simply and call it properly, it probably doesn't have to file a tax return.
Oh, okay.
So you're really mostly worried about that U.S. limited partnership.
Okay. Yeah, that's not so bad then. And I can see how if the more structures you've got, that starts piling up, right? Yeah. So,
and where we see things get really confusing is, you hear real estate investors talk all the time about, joint venture this, or, me and my neighbor are going to get in on this project together. And anytime, that's where accounting starts to get really complicated, because you have to account for each project separately and then bring it all together in the limited partnership. And so that's why we say like that, call it $600 to $1,950, assumes that all the bookkeeping is done and they're looking good and clean.
Okay. Well, that brings me to a really good question that I actually forgot about. If I have a joint venture agreement with someone else to buy property, the U.S. looks at that as a partnership,
right? And
they expect you to file a actual partnership return, right?
Sure.
Even if it's just a contract between me and my partner.
Yeah, I mean, like joint venture accounting, it looks a lot like a partnership, and you're right. You have to create your reports for that separately, and then everything comes together as one with the limited partnership filing. So that's why, like for me, when we started going down into Texas, my preference was to set up one U.S. limited partnership. Yeah. Make a set of rules around, hey, this is what we're going to do. In our case, we're going to buy long-term houses in Dallas, and we set some criteria for that. And then we went to our friends and we said, hey, everybody pools some money together, and we're all going to participate equally in this portfolio. And what we did was we tried to simplify that process by just saying, everybody participates in everything. It's when people start, making a whole bunch of one-off deals, and now you have to account for each one-off deal independently.
And they're all different.
And they're all different, yeah. And they all have different rules, and and this person lives here, and this person gets a percentage of this, and
Okay, so I think it's really important to have a plan going in.
I think so. Yeah. A little bit of foresight can go a long way.
Absolutely.
Yeah.
Okay. Another question that I get a lot of Canadians ask me, and this is, Americans talk about this all the time. It's the 1031 exchange.
Oh, yeah.
So maybe you could explain what it is first for those that don't know, and
Sure.
then if Canadians can take advantage of that or not.
Right. So, I mean, the 1031 exchange in the United States is basically, I sell a piece of property. If I take that money and redeploy it in another piece of property, I can defer the capital gains tax on that sale. Okay. Mm-hmm. And so for Americans, like that's a great opportunity. Yeah. Let's get on one property, let's go into another, and let's grow our real estate business, and that's really, really amazing and really cool. So the challenge with Canadians investing in the United States is any income that a Canadian earns in the United States has to go on their Canadian tax return. Mm-hmm. And this is another case where the rules don't always jive up. A 1031 exchange it exists for, US tax laws, but it doesn't exist for Canadian tax laws. And so, I mean, you can use a 1031 exchange, but you still have to pay Canadian taxes on the capital gain.
So it's not actually deferred in Canada.
It's not actually deferred in Canada. And in fact, the Canada-US tax treaty, we were talking about those foreign tax credits. Yeah. In order to get those foreign tax credits, you need to have US income, like pay US taxes on US income. Mm-hmm. And then in Canada, account for that same income so that you can take the foreign tax credit at the same time. Right. So if you use a 1031 exchange, you're deferring your US tax income to a future year, but you're paying taxes in Canada in this year. And so you lose that foreign tax credit. So using the 1031 exchange actually exposes you to double taxation.
Wow.
I know, that sucks.
So the opposite effect can happen to a Canadian. Okay.
Yeah.
So they're not looking ahead. The CRA is not looking ahead to anything that's deferred into the future. It just says we got to pay tax on that right this year.
That's right.
Okay. And then a few years later, the IRS is going to come knocking and say, hey, remember that deferred tax from the 1031? You owe that.
You owe that.
So they're not going to look back. Is the IRS going to look back and say, "Oh, you already paid Canadian tax on that"? Probably not.
No. You have to. You have to take the income in both countries at the same time.
So 1031 exchange. Do not listen to it, guys. If you're Canadian, it's not in your advantage.
It's not in your advantage. Yeah.
Good to know. All right, Chris, another question, and I think this comes from some of the training that people hear in the US, is that you can set up different structures or different entities based on the type of income. So say I have passive income, like a rental property. Do I want to keep rental properties in a separate limited partnership versus say I'm a house flipper or a wholesaler where I'm making passive or active income? Do I need to separate those types of deals as a Canadian investor?
That to me comes down to what your Canadian structure looks like.
Okay.
And I mean, I want to say most of the time, in most cases for Canadians investing across the border, it would be too complicated to try to split things out. Mm-hmm. But I mean, if you're dealing with enough money, it certainly makes some sense. So if you're a personal investor investing across to the United States, it's a moot point. Okay, it really doesn't matter.
Okay,
you wouldn't make it unnecessary. You wouldn't set up two limited partnerships if you were going to personally own both of them. Okay, mm-hmm. So the issue comes from in Canada, if you have income to a Canadian corporation, active income like flipping houses, short-term rentals like Airbnb, VRBO, anything that you're actively involved in, that is all what we call active income. Passive income like renting houses, like long-term rentals, or lending money if you're a private lender, those are passive income. And active income, taxed in the hands of a Canadian corporation, is taxed at, it would be different if it's cross-border, but it's taxed at a much lower tax rate than passive income, okay?
Mm-hmm.
And so some Canadians, and we work with a lot of our clients on this, some Canadians will make a point to split active income and passive income into two different Canadian companies. And, if you're doing that, and then you're going down across the border and you have active income and passive income, there might be an argument to try to keep things separate. But I mean, it would only make sense for like a fairly I don't even want to use the word sophisticated. There have to be enough money involved.
You have to be doing a lot of deals on both sides, probably.
Yes. Yeah,
so a lot of
makes
volume.
sense. And you'd have to have money in Canadian companies already.
Mm-hmm.
Right? If you're holding it personally, it doesn't make any sense.
Yeah. Okay. And if you're having to pay returns on all of those entities, then it might not even be worth it.
It might not even be worth it. Yeah.
Okay.
Yeah.
So to keep things simple for the most investors, it's just better to just have the one structure and just do your deals that way.
Yeah. Keep it simple.
Yeah. Okay. All right. Now, state tax. Not all states have state tax. You guys handle all that too, right? It's all handled on your side. Okay.
And, it's so funny. Some people hate Canada Revenue Agents. Actually, most people strongly dislike them at the very least.
Yeah.
And they're kind of a pain to deal with, and you wait on hold with them or whatever. I'll tell you the IRS is so much worse to deal with. Like people who don't like CRA, try dealing with IRS just a few times, and they are awful. People transfer you to different, and people will just hang up on you at the IRS.
After 2 hours of waiting or something.
Yeah, or you'll file returns with it. Did you know if your corporation is entitled to a refund from the IRS, the IRS is allowed to wait for up to 6 months before they have to issue the refund, okay?
No interest, I'm sure.
No interest. And so what we've been seeing with the IRS, I had one client, they were owed over $100,000 from the IRS, and this story is not uncommon. IRS will wait until 6 months to the day, and then they'll get this check from them. So they're just, I really dislike the IRS.
Yeah.
But I want to tell you, I was filing a lot of returns to the state of North Dakota. Okay, I had a box of a couple hundred returns, and they're all going to the state of North Dakota. And I'm going man, the poor sucker who's going to get this box. So I ship it out, and I've never filed this many returns to the state of North Dakota before. So I'm just okay, hopefully everything goes smooth, and. Whatever, 6 weeks goes by, and I see the name come up on my telephone display, and it says, state of North Dakota tax or whatever. Yeah. And I'm oh man, here we go. So I take the call, and it's this man, and he says to me, sir, we got your box of tax returns here, and I got this bit of a problem with them. And I'm oh, there's a problem? And he's yeah, right. Oh, wait, no, never mind. No, everything is all here. Oh, sir, thank you so much for filing your tax returns to the state of North Dakota. And I never heard from them again. Yeah. And it was I don't know, it was kind of awkward, but the man was surprisingly friendly.
Yeah.
And I was just man, I wish all tax, I wish every call that I got from the tax office, sounded like that.
Yeah, no kidding. Just easy. Yeah. So if I'm investing in different states, Chris, does it affect how my entities are structured, where and how that works?
It probably doesn't affect how they're structured, but I mean, if you're buying houses in multiple states, your limited partnership has to be registered in every state that you're working with, and depending on the state, it probably has to file a state tax return to every state. And so, for us, that's why we chose Texas, and only Texas, was in the interest of simplicity. And we just said, hey, I only want to worry about having registration in one state. Every time you register in a state, you need an address, which means you either need a lawyer, or you need to have a registered address down there, or a friend down there that you can use their address. You need to have an address down there. And so, for me, I just like trying to keep things simple. But every time you had a state, you had complexity.
Okay. All right, Chris. So I've been meaning to ask you for a while. do you have any kind of like horror stories of people that set things up completely the wrong way, or just maybe some advice that you've learned from these stories to help your clients out?
I had a group of clients once, Cal, who came to me after the fact. They were doing some filings on their own in the United States. And there is, as a Canadian investing across the border, there is a very specific form that you might be required to file. Okay? Might. Okay. Okay. And not everybody is required to file the form, but and the rules around whether you file them or not are complicated. So sometimes we just file the form just so that we don't not file the form. But in this particular case, the client did not file the form. And the penalty for not filing is $10,000 US. And so and a group of clients come to me like, Chris, we didn't file this form, and IRS thinks we're supposed to file the form, and now we all got bills from IRS for $10,000. I know, like nightmare. Yeah. And you could tell their blood pressure just like rose, and you're just like, oh man, they're feeling stressed. Yeah. So we can learn a big lesson from this. But in their particular case, and our office, we ended up writing some pretty well written / nasty letters to IRS, and we basically made the case that they didn't have to file. Yeah. And in their case, it was kind of borderline. I can't really go into the details for confidentiality reasons, but in their case, it was kind of borderline. And we got really lucky that every one of them, the IRS accepted our argument and waived the penalties for all of them. And so, it probably took a good 6 or 8 months or so to kind of really really resolve it. But
you got them out of it.
Yeah, we got them out of it. Wow. And now the clients, they love us for life. They're like, yeah, Chris, I have so much trust and respect for your office now because, we got them out of that pickle, and, it feels good. But it was, you could tell that, people were stressed.
Yeah. Yeah. Oh, I bet getting a bill for $10,000 US. Oh my gosh, that'd be scary.
And the IRS is so nasty.
I know.
Yeah.
Okay. So do you ever have people that try to do all the filing in the US themselves? I'm sure there's probably people that try.
Yeah.
And I wouldn't recommend it. There's just so many instances where I get so confused because it is confusing. It's a different country, different forms. I wouldn't advise it even if they're small.
Yeah, I really wouldn't recommend it. That's a perfect example.
Yeah.
Somebody who tried it on their own, and you're much better off to just pay an accountant than to get a surprise $10,000 bill.
Absolutely.
Yeah.
Yeah, and in my experience, I think if you're a real estate investor, your job should be to find deals, do deals, right? Put them together, whatever that might be. And I think something like this, trying to just waste your time trying to learn all this is just not worth it. Paying someone like Chris and his team to handle all the nuances and even go to bat for you with the IRS. I don't know what that entailed, but imagine having to write the IRS a letter yourself. I just don't think any of that is worth it. And having the right team, I've found, is just so important. Just sleeping at night, knowing that I filed it correctly and I'm not going to get a letter from the IRS or the CRA or both, right? So I think it's so important to have someone like Chris that knows both sides, right? Yeah. And because can a Canadian accountant handle this? That's not cross-border?
No. There's so many Canadian accountants who, they don't have a grasp on what that would look like. They say, go talk to a cross-border accountant, or we have a lot of accounting firms sending us referrals and stuff for that reason.
I bet. Yeah. Because there's probably not a lot of you guys out there.
Yeah, it's a very specialized space.
Okay. Yeah. And in my personal experience, when I first got started, I talked to someone on the American side, and they were like, oh, this is what you need. You need this corporation, all this stuff set up. And so that's what I did, only to find out later that I had everything wrong and I was paying way too much tax.
They gave you advice as if you're an American investing in America.
Yeah.
They gave you the same advice that they would give to any other client in the United States.
And they insisted to me that they were right.
Wow.
Even when I talked to a cross-border Canadian accountant, they're like, no, this is what you do. So just do yourself a favor and don't take advice from American tax people. It's just, you're barking up the wrong tree and the rules really don't apply. And that's the moral, right?
That's right. Yeah.
Okay.
Amazing, Cal.
Yeah. So Chris, how can people get in touch with you? Is it your website or email or phone? How do you like to be contacted?
Yeah, I mean, that's like our office, our general office email is accounting@pinnacleequities.ca. There's a double E in there. It's PINNACLEEQUITIES.ca.
We'll include it in the video too, so you guys can see it. Yeah,
that's right. Or calling the office directly is great as well. 1-403-453-0532, and yeah, we have a great team here, so we're happy to help people out.
Okay. Do you work with clients that are outside of Calgary, or is
Absolutely.
it just okay? So anywhere in Canada, you can work with people.
Yeah, we have clients all over the world, Cal.
Okay.
Yeah, we're in our boardroom studio today, and we use it to do video conferences with clients who live like Amsterdam, who has property here in Canada, or we have clients in Ireland, Brazil, like Hong Kong, like all over the world. And so
awesome.
Yeah, we're very comfortable with. If you live in Canada, that's an easy one.
Yeah, absolutely.
Yeah.
Okay, guys. Well, I strongly advise you to look into this more and just sit down with someone like Chris. I prefer you sit down with Chris because he's a very knowledgeable guy, and just hash out what your plan is before you start going, because this is something you really need to have your T's crossed and your I's dotted before you just jump in. And I know in a lot of my other videos I say action, just jump in and do it, but this is one thing you have to get right so you don't make mistakes, I think. So
amazing.
Yeah.
Thanks, Cal.
All right, Chris, well, I appreciate your time.
Great.
And we'll have you on do some more videos in the future, I think.
Beautiful.
All right.
Good.
Thanks, guys.
Bye.